What do you think matters most in the dollar world? Money? No. The most important thing is an account eligibility card. Listen carefully. It's not the account, it's eligibility for the account. That determines whether you can board the dollar clearing plane directly. If you can, your assigned seat determines whether you get a seatbelt, whether you can ask the flight attendant for a blanket, and how much luggage you can bring. If you can't get one, you have to find someone next door who did and have them buy your ticket. They'll charge a ticketing fee, called a correspondent banking fee. The whole world's cross-border payments have been paying this fee for more than 100 years. This week, on May 20th, 2026, the Federal Reserve approved a formal proposal to issue a new kind of ticket. Every financial media outlet is saying the Fed is opening the door to fintechs, crypto banks, and new payment institutions. I read the document, and I'm telling you, that door hasn't opened an inch. Welcome back to Money Daddy's Financial Comics channel. Like first, watch afterward, and may your financial road be long. All right, let's get into today's program. What the Fed is doing this time isn't opening the door to outsiders. It's starting its own airline, issuing an economy class ticket, selling it itself, and flying the plane itself. The airport is still its own. I call this new ticket second class. Its English name is payment account. In Chinese, that means payment account. It's a restricted Fed account proposed by the Federal Reserve, issued only to legally eligible financial institutions for payment, clearing, and settlement. Don't be fooled by the words payment account. It sounds like Alipay or a WeChat wallet on your phone, but it isn't. It's an account on the Fed's own balance sheet, on the same ledger as the master accounts used by major commercial banks. But this second-class ticket has 4 words printed plainly across it. No. First, it pays no interest. Your money sits on the Fed's ledger and earns nothing. Second, you can't use the Fed's discount window. The discount window is where the Fed lends to financial institutions. When a liquidity crisis hits, it's what helps them breathe. Your second-class ticket doesn't come with that lifeline. Third, no intraday overdrafts. During the day, ordinary big bank accounts can temporarily go negative and be topped up in the afternoon. That's called intraday credit. A second-class ticket doesn't allow it. Fourth, if the account goes negative, the system automatically rejects the transaction. It's not a fine afterward. You're stopped on the spot. There's also a balance cap. During the earlier public comment period, the proposed limit was $500 million, or 10% of total assets, whichever was lower. In this formal proposal, it changed to a closing balance cap based on expected payment activity, up to $1 billion, about 7 billion yuan. Do you get it? This isn't an all-access pass. It's a restricted identity card. You can enter the clearing station, but you can't fly first class or use the plane's own safety net. But if you only see this layer, you'll miss the real story underneath. Let me sketch the hierarchy of account identities in the dollar world, and it'll be obvious. Dollar accounts aren't on a flat plane. They're class-based with 4 levels. First level, first class, called the master account. These belong to member banks already inside the Federal Reserve System, JP Chase, Citibank, Wells Fargo, Bank of New York Mellon, and that tier. Their accounts are the central ledger between the Fed and the banks for all settlements, all inflows and outflows, and all intraday balances. They can use the discount window, draw intraday credit, and access almost all of the Fed's financial services. The Fed's own manual says it plainly. The master account is the central ledger for all financial rights and obligations between the Fed and the account holder. It's first class with blankets, customer service, seatbelts, and full rebooking privileges. Second level, economy class. That's the payment account proposed this time, the second-class ticket I mentioned. Eligible payment institutions with limited uses and reasonably low risk can get this ticket. They can use FedWire, the Fed-operated large-value dollar payment system. They can use FedNow, the instant payment system launched by the Fed in 2023. And they can clear and settle dollars. But all 4 restrictions apply in full. Third level, buying your ticket through someone else. This is the biggest tier and the real position of most players. The vast majority of fintechs, crypto companies, cross-border remittance firms, and e-commerce payment platforms don't have bank charters or access to a Fed account. So how do they move dollars? They use a bank with a master account to settle transactions on their behalf. In English, that's called correspondent banking. You're overseas, and you use a payment app to send or receive dollars across borders. Behind the scenes, there's a chain of correspondent banks moving the money along. Every leg of that journey comes with a fee. That's the dollar system subletting network. The fourth level is being denied boarding. You don't qualify, your risk is too high, or your compliance isn't good enough. The Fed won't even let you join the line. All you can do is stand on the ground and watch the plane take off. So, from first class to being denied boarding, there are four levels in all. Money isn't the problem. Eligibility is. Do you think the Fed's new economy class ticket is inviting people who were denied boarding onto the plane? No. It's moving some customers from level 3, who used to buy tickets through someone else, up to level 2, where they can buy their own economy ticket. To understand what the Fed is really worried about, let's look at two stories about applicants who were denied boarding. The first is Custodia Bank. Custodia was a special purpose depository institution registered in Wyoming, known in English as an SPDI. This is a Wyoming charter designed specifically for crypto asset businesses. It provides services such as custody and settlement for crypto companies. The person behind Custodia is Caitlin Long. She didn't come from nowhere in the crypto world. She spent more than 20 years on Wall Street, served as a managing director at Morgan Stanley, and was a veteran of fixed income and clearing operations. She brought that Wall Street experience in compliance and clearing back to Wyoming, hoping to build a bank that followed the rules, met the Fed's standards, and still served crypto assets. She began applying in 2018 and pursued it for more than 5 years. On January 27, 2023, the Federal Reserve Board formally rejected Custodia's application to join the Federal Reserve System. The rejection letter was blunt. It said Custodia's crypto-centered business model created significant risks to safety and soundness, and that its anti-money laundering and counter-terrorist financing controls were inadequate. Caitlin is still fighting the case. It has reached the United States Court of Appeals for the 10th Circuit. The lawsuit isn't over, and we don't have the latest court ruling yet. So everything that follows is based on the publicly available record. The second case is TNB, or the narrow bank. The person behind TNB is even more interesting. His name is James McAndrews. He wasn't a longtime entrepreneur. He used to be a research director at the New York Fed, so he was an insider at the central bank. After leaving the New York Fed, he wanted to create a very simple kind of bank. It would accept money only from large institutional clients, place that money untouched in a Federal Reserve account, and earn the interest the Fed paid on those balances. It would make no loans, conduct no off-balance sheet business, and make no investments. That's why it was called a narrow bank. It sounds harmless, right? But after applying for a master account in 2018, the version seen by Banking Dive says the New York Fed rejected TNB's application on February 27, 2024. The stated reason was that this model could create excessive risks to the stability of the United States financial system and interfere with the Fed's ability to carry out monetary policy. Keep in mind, that account comes from Banking Dive's report. The Fed has not released the original rejection letter. So when I cite that version, I'm doing so with that limitation in mind. Put the two stories side by side, and the picture becomes clear. Custodia wanted to be a crypto asset bank, and it was rejected over compliance concerns with its crypto business model. TNB wanted to be a pure interest collector, and it was rejected over monetary policy transmission and financial stability. Those two cases are very different, but they ran into the same thing: the Fed's power to approve account status. The Fed isn't afraid of the word fintech. It's afraid of all the different ways people might use a Fed account to create leverage. But remember, the economy class ticket I described earlier is for qualified payment institutions with limited risk and narrow uses. It didn't solve Custodia's compliance problems, and it didn't solve TNB's monetary policy problems. So these two denied boarding stories are not the same story as the new payment account. What, then, is the economy class ticket actually designed to solve? This is the real second level of the system. Let's take a look at the Fed's family history. This isn't the first time the Fed has issued a restricted identity card. In 1919, Congress passed the EDGE Act, allowing American banks to establish subsidiaries dedicated to international banking. These subsidiaries had more limited powers than ordinary banks and could operate only across borders. But they received a special identity for international clearing, bringing them close to the Federal Reserve System. That tool is still in use today. It was called an edge company. Then, in 1981, the Fed approved another tool called an International Banking Facility, or IBF. It let banks in the United States keep a separate offshore book for lending to and taking deposits from non-U.S. residents under different reserve and regulatory rules. It was also a restricted identity card for a specific purpose. Together, these two things reveal an old formula in the Fed's institutional toolbox. When more financial businesses want access to the foundation of dollar clearing, but putting them all into existing first-class master accounts would create risks, the Fed doesn't just keep saying no, but it also doesn't tear up the tickets and hand everyone first class. Instead, it designs a specialized, restricted, controllable ticket. The second-class ticket is the latest version of that formula. At this point, we can spell out the deeper story. Financial media are asking, who is the Fed letting in? But from another angle, what the Fed is really doing is not opening the door. It is gradually bringing part of the dollar clearing business outsourced to commercial banks over the past several decades back in-house. Look again at those four levels of access. The third level, buying a ticket through someone else, has been the core of correspondent banking for decades. Fintech firms, crypto companies, and new payment companies all need a big bank with a master account to act as their correspondent if they don't have a Fed account themselves. For major banks like JP Morgan, BNY Mellon, Citibank, and Bank of America, this business, handled by their transaction banking divisions, is a very stable and fairly profitable source of back-office revenue. Once the economic class ticket is available, some third-level customers have another option. If they meet the legal requirements themselves, they can go directly to the Fed's own window and get a second-class ticket without routing through a major bank as an intermediary. I'm not here to predict which listed company's profits will be affected. That kind of earnings forecast isn't what we do. I'm talking about a medium to long-term shift at the industry level. I have a friend who works in the correspondent banking division of a global bank. A couple of years ago, over dinner, he told me that his team's core performance metric was the intermediary revenue from cross-border dollar clearing channels. Not long after he saw this proposal, he posted one sentence on social media. Over the next 3 years, we'll have to do the math all over again. He wasn't an isolated case. This is something the entire correspondent banking industry will have to face. But the story doesn't end there. Look again at the four things the account cannot do: pay interest, lend money, go into intraday overdraft, or allow overdrafts automatically. Now look at the services available through the payment account. FedWire for high-value payments, FedNow for instant payments, the National Settlement Service, and delivery versus payment securities transfers. Can you combine those functions into an institutional-grade, direct connection to the Fed's ledger, operating 24/7, with compliance controls, a balance cap, and no interest payments? Yes, and that happens to cover a major part of the design goals for a central bank digital currency, or CBDC. I call it a CBDC that never calls itself a CBDC. Watch my wording carefully. In the Fed's own documents, there isn't a single mention of the letters CBDC, and nowhere does it say, we're creating a central bank digital currency. That must be clear first. This is not the Fed's official position, but functionally, the payment account overlaps considerably with what a central bank digital currency is designed to do. Why does that matter? Because central bank digital currency is highly sensitive in American politics. Republicans in Congress strongly oppose federally issued central bank digital currency, citing concerns ranging from personal privacy to monetary freedom. Republican lawmakers have been especially vocal against a federally issued central bank digital currency for reasons ranging from privacy to monetary freedom. The Treasury and the Fed have repeatedly said in public that they have no plans to issue a retail central bank digital currency. But within the institutional toolbox, a payment account can gradually introduce its core functions without ever carrying the CBDC label. That's what I call a side door digital dollar. It doesn't use that name, but it does the job. Let's put this in perspective with one figure. The Fed has its own main artery for dollars, called the FedWire Funds Service. In 2025, FedWire processed 217,296,700 large value transfers, worth a total of $1.148 quadrillion. I'll repeat that, quadrillion. In yuan, that's roughly 800 quadrillion yuan, or about $4.593 trillion a day on average, equal to roughly 32 trillion yuan. That's a pipeline moving about 32 trillion yuan every day. Now compare that with the payment account balance cap, $1 billion, or roughly 7 billion yuan. You might think these figures aren't even in the same league. A payment account is just a tiny cup. But that's the observational trap. The Fed doesn't need to fill every account. It doesn't need cups for holding water. It needs interfaces connected to the pipeline. Let me do the math. 4,593 fully funded payment accounts would hold roughly the same balance as FedWire moves in a single day. And you don't need every account to be full. The goal is to gradually shift settlement activity from going through correspondent banks to being connected directly to the Fed's own channels. Once the channel is connected, the flow will come on its own. Then add the new pipeline, FedNow. Launched by the Fed in 2023, FedNow processed more than 330,000 payments in the third quarter of 2024, according to the ABA Banking Journal, worth nearly $17.5 billion, or roughly 125 billion yuan. That volume is still in its early stages, but its biggest feature is settlement 24 hours a day, 7 days a week, 365 days a year. Now layer those two pipelines together. FedWire's trillion-dollar wholesale backbone, FedNow's 24/7 instant payment layer, and the payment account layer with direct access. That's the full back end of a digital dollar that never calls itself a digital dollar. The Fed doesn't need to issue any new kind of digital dollar or call it a central bank digital currency. It just needs to connect more eligible institutions to these two rails through restricted payment accounts. The digital dollar's functional layer is already running there. Let me walk you through two common objections. First, you may be thinking, isn't this a conspiracy theory? The Fed's own documents don't mention central bank digital currency at all. I'm not pushing a conspiracy theory. As I said earlier, the Fed would never write central bank digital currency in its documents. Politics wouldn't allow it. I'm saying the proposal's functions overlap heavily with what a central bank digital currency is meant to do. You can compare this with any Bank for International Settlements paper on wholesale central bank digital currencies. The logic is the same: direct access to the central bank ledger, institution-level access, live compliance controls, and a balance-based payment tool. Also, in the Fed's own request for public comment, some of the 73 published comments discussed stablecoin redemption mechanisms and issuer balance limits. That doesn't make it official Fed policy, but it shows the industry is thinking along the same lines. I'm not the only one making this connection. Second, you may be thinking, are you overstating the losses for correspondent banks? How much business could a global bank really lose because of one small ticket? As I said earlier, I'm not predicting a profit decline for any particular public company in any particular year. I'm talking about a long-term industry-wide impact. For decades, the most stable profit model in dollar clearing has been this. The Fed provides master accounts to a small number of major banks, and those banks earn fees by acting as correspondents. This model won't collapse overnight, but it will slowly be shaved down. The portion that disappears will move back into the Fed's own channels. And I want to be clear, this isn't about accusing the Fed of being bad. The Fed has its own logic. It worries that narrow banks could pull too much cash away from large institutions and distort monetary policy transmission. Crypto bank activities bring anti-money laundering and settlement risks, and if intraday overdrafts are abused, the risks on its own balance sheet could spiral out of control. So instead of giving every applicant a full master account with first-class access, it designed a restricted economy-class ticket. It lets in institutions considered manageable risks without giving them the full central bank safety net. On the other hand, Catering Loan has its own logic too. A Wyoming Special Purpose Depository Institution is a legally registered financial institution, and Custodia is regulated by the state of Wyoming. It has done substantial compliance work. Their argument is simple. A legal institution applies for a legal account, and the Fed's long delay in approving it harms compliant innovators. Neither side has the whole truth. Both sides have a case, depending on where you're standing. Now let's look across the Atlantic. The European Central Bank began its digital euro preparation phase in November 2023, and as of 2026, it is still moving through legislation and testing. Europe's approach is to openly acknowledge this as a central bank digital currency and make the digital euro a retail tool for ordinary people and businesses. It is willing to fly that flag openly. The United States is taking a different path, no flag, but gradually bringing central bank digital currency functions into the wholesale market through restricted identities like payment accounts. Europe plays its card openly. The Fed plays its card cautiously. Over the next 5 to 10 years, their balance sheet designs may look very different. We're almost done. Look back at this episode. On the surface, the Fed issued an economy class ticket this week called a payment account for eligible financial institutions. Look one layer deeper, and it is using that ticket to bring part of the correspondent banking business back in-house. People in correspondent banking departments will smell this coming long before any influencer does. Look one layer deeper still. Combine this economy class ticket with FedWire and FedNow, and you have the back end of a digital dollar without the central bank digital currency label. The Fed won't admit it, but functionally, that is what it's doing. Remember a term we coined before. In our earlier episode on Google I/O, we called it an entrance tax. Every time you use someone else's gateway, you pay an invisible tax. Fintech has always wanted to bypass more than a few invisible entrance taxes. It wants to bypass the intermediaries across the entire dollar clearing path. Now the Fed is stepping in too, saying, I'll be that intermediary myself. Go back to the economy class ticket from the beginning of the show. You now know what it didn't say. The airline is run by the Fed. The airport is the Feds. The routes are the Feds. The control tower is the Feds. and even the fuel depot belongs to the Fed. Here are the final two questions for you. When America's stablecoin legislation is complete, should eligible stablecoin banks get this kind of economy class ticket? And if they do, will the stablecoins behind them be tied to the same account on the Fed's ledger? The second half of dollar dominance may no longer rely on visible tricks like printing money. It may rely on deciding who gets onto the Fed's ledger, who gets first class, who gets economy class, and who stays on the ground watching the planes take off. See humanity through money and truth through power. I'm Money Daddy. See you next time.